right, so let's go ahead and get started. I already started the recording. So for those that aren't familiar with SRM Tech Talks, we get together every other week as an industry forum to talk about kind of the intersection between traditional finance and emerging kind of fintech technologies. And so that's going to be the focus today. What I want to talk about, we often have guest speakers. I love when I get a chance to talk because I like to talk. But today we're going to cover my observations from Money 2020. So we're just talking about the REACH conference that was out there in Las Vegas. Money 2020 was going on at the same time. And this was my first time I attended it. So I've always been envious of my colleagues who've gotten to go to those things. And so this was my first one. And I certainly wasn't disappointed. It was 4 days of really insightful presentations, thought-provoking discussions, and connecting with old colleagues and making new friends. There was 15,000 people there, I think, may have been more that attended. And then there was a lot more that came into town just to set up calls with prospects and clients. So, well attended for sure. Before I get started, let me preface this overview by saying that there's no real way to attend all the speaking events, as there was a lot of events that were kind of running concurrently with others. But I did sit in on 16 of them and took copious notes. So that's what I'll be sharing today is some of those observations. Of course, I attended those conferences that interested me, so there's probably some self-selection bias in what I captured. But with that disclosure out of the way, here are my key takeaways. So, it'll be no surprise to anyone that knows me. The topic that interested me the most was the promise of digital assets, blockchain, and artificial intelligence. There's more than one comparison of cryptocurrency, blockchain to artificial intelligence, which was not a surprise, given that both have had some pretty significant hype cycles. Not that hype is a bad thing, but there is that kind of Gartner hype cycle that new technologies go through. Both kind of digital assets and artificial intelligence, not to throw them into the same boat, but they both kind of promise to transform finance. In both cases, we've got legislators struggling to understand the risks and opportunities. And then weirdly enough, both have had White House announce, kind of executive orders requiring federal agencies for feedback and plans. I'm hoping that Congress does a little bit better job with the artificial intelligence and regulatory guidance than they have so far with digital assets. But we'll see, and time will tell. AI, was probably the most discussed thing there at Money 2020. Certainly on the strategic roadmaps of most financial institutions. In fact, my colleague Connor, who's on this call today, mentioned earlier, he was at the California, Nevada REACH conference in Las Vegas at the same time I was in Money 2020, and he was there actually presenting on AI. Much of the research on how to use AI, at least in the financial sector, has been around risk compliance, AML, enhanced transaction monitoring, account decisioning, operational enablement, process enhancement, client engagement, probably the most interesting, which is enabling hyper-personalization as it relates to kind of product offers and marketing. The one thing to consider, though, is from the conference, these conversations was that, the application of AI is not going to come without its risks. And Connor is, for anyone that wants to talk AI, he's a great one to reach out to at SRM. He'll talk your ear off on it. He's a real expert. But, a lot of these AI outputs and decisions are really still kind of a black box, and there exists challenges certainly with explainability of any decisions they might make and risk of negatively impacting underrepresented peoples through various biases that could exist in the AI training data. There are currently emerging discussions in Congress with regulatory bodies about AI, and we've seen post-Money 2020, as I mentioned before, the White House issuing an executive order on AI. This executive order establishes AI governance structures in federal agencies, advanced responsible AI innovation, increase transparency, protect workers, and manage risks from government uses of AI. So, more to come on that, but AI was a really big topic of conversation at Money 2020. I want to pause because I know there are others on the call that were also in attendance with Money 2020 or Reach that might have opinions or want to say anything on AI, about the promise, about the risk of it, outside of the comments I've already made.
Yeah, Larry, if I can add into that. So the keynote, hopefully I'm not stealing your thunder and you weren't going to get to this. Ben Horowitz was one of the keynote speakers. That was Sunday evening. And he spoke about how, think back to early days of computer science, and neural networks in the 80s was an example of how computing is going to change, basically an example of early AI. And don't think that the AI that we see today, ChatGPT, is kind of the most common, only because that's the most public, but there's it's been around for a lot longer. Don't think that the AI that we see today will be anything that we will know in 10 years from now. And he did say that AI today is probabilistic, right? You can ask the same question 20 different ways, and you'll probably get 19 different answers. He brought up an example using AI for financial advising. AI may be better than any individual at predicting the stock market, but it'll probably recommend that you should buy Dogecoin and you should buy glitter because glitter's in short supply. So having and for those of you, Ben Horowitz is the Z of A16Z, or Andreessen Horowitz, probably the largest investor in blockchain distributed ledger space, and it looks like they're starting to also invest in the AI space.
Thanks, Lou. Hey, Lou, for those that don't know you, I'm guessing everyone probably knows you on the call, but you want to just give an introduction of your role there at PSCU and what you do?
Oh, and in case anybody didn't hear, some big news on Monday in the credit union space, at least it's huge news. Hi, my name is Lou Grilly. I am a senior innovation strategist. I'm in the innovation group within PSCU. So within the product organization, there's a separate group carved out to look at product adjacent and transformational things like crypto, distributed ledger, blockchain, instant payments, fast payments, digital onboarding, those kinds of things. And so that's kind of what I do for a day-to-day. And then just in case you missed the news, PSU is the largest QSO in the US. And we just on Monday agreed to a merger, not completed until the end of the year, subject to vote by our respective members, with Co-op. So that will consolidate the industry, and we believe will be much better for credit unions, at least in the world of credit and debit processing and contact center. But several years ago, while I was at FIS, number of us in product management worked on a patent, and we were issued a patent on implementing a loyalty program on blockchain. It was kind of a scorecard at FIS, if you're familiar with that. And since then, I've always been interested in the promise of blockchain and distributed ledger for things like tracking auto titles and property titles and money movement. But real world tokens is something that I'm really interested in. And so I was attending sessions at Money 2020, kind of focused on things that I could take back and add to my talk track when I'm talking to credit unions.
So Lou, that's a perfect lead into the next takeaway I had, which was around crypto and digital assets, which also include obviously blockchain and underlying technologies. But after, I'd say, about 2 years of setbacks, FTX, the Terra Luna, a whole mess load of them, Celsius, it is making a comeback with large, responsible, heavily regulated industries entering the digital asset space. We saw PayPal's rollout of their stablecoin, which was PYUSD. We've seen BlackRock's interest in an ETF. We were talking about that earlier. There's a lot of rumors about a number of ETFs, spot ETFs being issued by the SEC, along with about a dozen others lining up for those EFTs. Citi has a tokenized collateral network. So Lou mentioned tokenized assets. So does JP Morgan's Onyx division. Then, there's some other large institutions out there. Circle Stablecoin is getting ongoing adoption in the world. Interestingly, stablecoins are responsible for about $7 trillion of value movement, which is a fair amount. And then we're starting to see trials like the Regulated Liability Network. That's my latest favorite thing I've been focusing on to really push things forward. A little on that, the RLN, which I don't know that it's talked about at Money 20, but I'll talk about it because I like it. It's a trial that involved SWIFT, MasterCard, HSBC, Lloyds, OCBC, ANZ of Australia, Citi, TD, Wells Fargo, US Bank, and Truist. It's since expanded to about a dozen more banks, and it's basically a tokenized deposit network that poses competition to RTP, FedNow, ACH, and possibly the payment networks. Kind of explores technical, legal, and business characteristics necessary to provide on-chain 24/7 programmable final settlement in sovereign currencies consisting of liabilities of both public, private, regulated financial institutions. So anyone interested in a great white paper, you can go to their website. It's I can drop it in the text. It's regulatedliabilitynetwork.org. I'll throw it in the chat. And then really, going back to kind of digital assets, the stakes with digital assets, digital ledger technology, and related are much higher right now, I think, due to the sheer size and volume of the companies that are entering this space. We are seeing legislative crypto conversations continue. Discussions to date with Congress have been largely focused on stable coins, with debates around the need to modernize regulations compared to other countries, civil privacy concerns, debates around federal versus state oversight. That's kind of what they've been hung up on. According to at least one industry expert, Columbia professor Austin Campbell, for anyone that follows Austin, he's a really great resource in the digital asset space. He said there's at least a 50% chance that legislation gets passed before next year's November presidential election, which I think is pretty hopeful. I really hope that's the case because I think we're falling behind the rest of the world. There's definitely an increasing recognition that underlying technology of cryptocurrency, the blockchain, cryptography, tokenization could really offer real-world benefits for financial institutions and commerce, leading to cheaper, faster, 24/7, 365 final settlement, reducing settlement and counterparty risks, and providing solution to kind of package together international commerce. Unfortunately, progress to date in the banking sector has been pretty slow, largely outside of really large banks, largely because of skeptical financial banking regulatory bodies. However, fortunately, in the credit union space, we've got a much more supportive regulator than CUA. But there does appear to be a change in the tide, and I'd be interested, Lou, if you felt the same too, but there seems to be a change in the tide with concern that some of that overzealous regulatory approach is leading to the U.S. falling behind financial innovation, which is threatening to accelerate the current de-dollarization that we're seeing at the global stage. In fact, there was a gal named Amanda Wick who did a really neat talk about de-dollarization. I don't know if it's someone might need to go on mute. I don't know if anyone else saw Amanda Wick's talk, but it was really fascinating. She's written a bunch of good articles out there. She was a former, I think, lead investigator for the U.S. House Financial Services Committee, but really smart lady. Had some really interesting thoughts about it. But Lou, anyone else? I'm getting the feeling, at least with some of the digital asset tokenization stuff, I think there is that kind of greater understanding that at least we're starting to feel like we're falling behind the rest of the world.
You did mention you used the word overzealous, and usually that is at least one way of referring to the SEC's stance on the industry. The SEC has lost a couple of key battles against Ripple, and Ripple was very, very promising, like I would say up until 3 years ago, and then nobody wanted to touch XRP, their coin, because they're in trouble with the SEC. I was really pleasantly surprised on the exhibit. If you haven't been to Money 2020, the exhibit floor is huge, but it's also kind of a telltale as to who's who in the industry. So when you walk in, the primary real estate is like, these are the people who are paying the most money for exhibit space. Socure on one side, So yeah, digital identity, that's huge. Discover, on the other, scratch my head, have no clue what they're trying to do there. Definitely, Money 2020 is moving away from appealing to kind of banking, just generic TradFi, and definitely wanting to move into AI and startups. But then you're continuing on, and then where the paths can diverge, Circle had this. No, sorry. Ripple had this huge display because this is basically their coming out. Like, okay, we're emboldened now, and I don't think I agree with Austin Campbell's prediction. I hope so, but no, I don't think that we're going to see regulation. But certainly, here's Ripple banking on the fact that yeah, we're out. We're not done yet, not out of the woods, but their success. And then you keep walking on, and there is Circle, and Circle had this. Yes, Larry was talking about stablecoins just a few minutes ago. Circle had a huge footprint on the exhibit floor. That's a very expensive space. And I was chatting with guys from Circle. 70% of all USDC, Circle is the issuer of USDC, is held outside of the US. So definitely stablecoins are taking on, and Paxos had a presence on the display floor. Paxos is the one that's partnered with PayPal to issue stablecoins, stablecoin. Firebox, Ripple backed at a larger exchange. Bitstamp, Stellar had a large presence, and they had a lot of sessions, including a private luncheon, which I attended. About their luncheon was about real world assets, digitizing real world assets. So I use the who's who on the exhibit floor as a proxy for like what companies are out there in the lead, who want to make a splash. And just as an aside, hopefully this doesn't take us too far. No FIS, no Fiserv, no Visa on the show floor, and yet here's Circle and Ripple with huge presence on the show floor.
There was MasterCard, but one of the things MasterCard is doing a lot in the digital asset space, including they've launched a trial tokenized network to kind of connect CBDCs. So again, it kind of ties all together there. I promise we won't talk entirely about digital assets, although that's the passion of a number of us on this call. But one of the other topics of conversation, it's not surprising given that one of the talkers there was from the CFPB, but there's a lot of conversation about banking access and financial inclusion. So the Biden administration, Congress, regulatory bodies are very much focused on inclusion and equity in financial services. There were conversations about how to serve banking deserts, address underbanked consumers, reduce fees and cost of payments, and the need to prepare for upcoming open banking standards, which is the CFPB is pushing, and their increasing role in all of that. For those that haven't been following the open banking stuff, Section 1022 of the Dodd-Frank provides for open banking in the U.S. CFPB, of course, is leading that effort, focusing on privacy and consent, making sure the data that's being used by a third party can't be used beyond its initial use case. So really focused on consumer consent. Financial institutions won't be able to disclose their way out of using that data beyond kind of initial consumer expectations. That's what CFPB wants to ensure. To support open banking, banks and financial institutions will need to make technology investments. So those are worth thinking about if you're a bank or credit union, thinking about that now, because the timeline is for the CFPB is finalizing their role by the fall of next year, 2024. They're going to be soliciting public comments that are due, I think, in early December of 2024. So they're going to get those comments, finalize a rule, and then in 2025, they're going to have, the expectation is that either, depending on the size of financial institution, you'll have either 6 months or up to a 4-year for rolling out that open banking. So open banking APIs connect into third parties like fintechs and others. That's going to be dependent on the size of institution, whether or not you have online banking, ability to adapt, et cetera. So I think those rules are still being sorted out. There is expectation that the CFPB, from the CFPB, that open banking will help level the playing field between large and small financial institutions in the future, with the smaller financial institutions having access to large bank consumer data. So I see it as going two ways. It's everybody's going to have to make their data available at the request of the consumer or the members to third parties. So those third parties could be fintechs. So that, I think, that poses a risk. It could be large banks or small banks. But if you're a smaller bank, I think you've got a lot more to gain by having access to some of that consumer data from the large banks. So again, the expectation is a leveling of the playing field. There was also a presentation in one session about NCR and Walgreens partnership. I sat in on that. Walgreens has offered financial services for over 20 years in kind of those banking deserts that I mentioned earlier. They offer low or no fee access to cash solutions and deposits. Walgreens said that their locations, which again are mostly low income areas, not serviced by banks, that is critical as traditional branches there are closing. They offered no fee partnerships into alternative banking apps. So again, they're providing a deposit route and on-ramp to those alternative banking apps being things like fintechs, bill pay providers, aggregators, and really as a cash on-ramp for small businesses, particularly businesses like the gig economy. Interestingly, Walgreens, I don't know if I'd agree with them on this, but they had a strong belief that banking is becoming a utility. I suspect a number of fintechs would probably also support that argument. And then there is a fair amount of focus and interest. I'd met with a couple people on the floor around self-directed investing products, focused on how to bring those self-directing investing products to masses by embedding investing solutions into digital banking apps. So, it's important to know, this was some of the stats, large financial institutions, they're talking about the largest banks, they're seeing annually on average about 1.4 billion being transferred out from bank accounts to investing solutions like Robinhood, Acorns, and Webull. And then if you look at all banks and credit unions, over 350 billion in deposits. And I think, I know we've got Rob Goodyear on the call. He's very much involved in this space, but I think that number is something like 350 billion in deposits that have been transferred out, with 80% of those outflows being from millennials and Gen Z. So there is no doubt an opportunity for banks and credit unions to kind of step up and offer solutions, often through third-party partnerships. And I'll actually let Rob, if he wants to do a little plug there or talk a little bit about that. But I'm going to talk a bit more still about those fintech solutions. But Rob, do you have anything you want to add there?
Yeah, I'm not going to shill or plug, but I'll back up what you said. It's 350 billion a year in outflows, is the most recent estimate, and it's not going to slow down, right? Yeah. So I'm kind of shocked at the numbers that you spoke of at the top. But maybe the answer is in the question there, which is to say, it's kind of getting back on the balance sheet through the side door. But the 9,500 banks and credit unions outside of the top 60 or so, Wall Streeters are suffering, and there's no reason for that.
And I think those big ones have been the influx of a lot of, kind of a safe to quality after the April banking crisis of deposits. And I think they probably have some of the more, they have kind of the better offerings or maybe more advanced offerings for consumers. So they probably don't have as much of a problem of those outflows as, say, the smaller institutions. But the opportunity is that we're seeing fintechs like Rob's and others that are stepping up to offer banks and credit unions self-directed and robo-investing solutions to clients that aren't typically serviced by a bank or credit union's wealth management business solution. So you think about, most banks and credit unions have a relationship with drawing a blank.
Raymond James LPL.
Thank you, Raymond James LPL.
Yep.
That the service is at 1 or 2%, but everyone else doesn't get offered any real services, and so they're going out and getting self-service through the Acorns of the world and the Robin Hoods, and to lose those deposits in a time when banks and credit unions are already suffering from a liquidity standpoint is pretty daunting. So the benefit of embedding financial apps, embedding financial investment apps, is to provide much needed product to a large segment of the typical client base that's not served today, stem those deposit flows, generate trading revenue, deepen the client relationship, ensure frequent engagement with those using the apps. And then, the speaker, at least one of those conferences, drew an analogy to PayPal, which I actually thought was an interesting one, in whether or not you want to count PayPal in terms of like investments, but like when PayPal embedded their digital asset trading into their app, right? So they offered Bitcoin and those sorts of things. They offered it to their, I don't think they offered it to all of their worldwide customers, but they got 388 million worldwide customers, 20% of their customer base, probably a little bit over that, about 77 million customers, quickly utilize that service, allowing PayPal to deepen those relationships and generate significant trading revenue. So the thought is, if you're a bank and a credit union, and there may be an opportunity to gain back those deposits, to gain back or deepen that relationship by offering self-directed investing products. So that's certainly one of the things I saw. I'll pause, see if anyone else maybe had observations from Money 2020, if you sat on any of those talks, or but feel free for anyone else to jump in. And feel free to ask questions if you want to. If not, we'll keep moving right ahead. Oh, go ahead.
I have a question for Larry.
Sure.
I was last year, so I've attended Money 2020 almost every one. I missed the very first one down at the Aria, and 2019 I didn't get to go. 2020 was canceled because of COVID. And it's interesting to see. So fraud was an interesting topic that I did catch a lot of sessions on, because that's something I'm doing for work. But last year, Metaverse, Microsoft's exhibit space was almost dedicated to Metaverse and their mesh network. Sandbox was there, Meta was there, Adobe had a huge display, and all these either were touting their technology to promote or further virtual reality, or using VR at least to display. I searched all of the content because it's a search string, and the word metaverse was not in any single session description, and I didn't even see any virtual goggles being used throughout the exhibit floor. So question, did you see anything to do with metaverse?
No, it'll be interesting. I think I might have, in one of the sessions, I think the word came up, but for sure there was no focus on it, like none whatsoever. And that's an interesting observation that I actually did not capture, Lou. So I think that's worth thinking about. What does it mean for Meta and their investment in that technology? And it might be one of those things where, sometimes a technology comes out, people get excited about, and it's too early, right? I think there are real applications for some of that technology to service, underbanked customers or members that are living in those banking deserts. Like, I think that's a real use case scenario for Metaverse, servicing younger customers that may be in that space, like kind of, servicing those members and customers where they are, which may be in the Metaverse, but I think it's early. So moving on, one of the things themes I captured was that banking is becoming fragmented and third-party fintech relationships are getting complicated. As you know, if you're a financial institution, the traditional things of deposit taking, lending, payments, capital formation are increasingly being provided by fintechs or fintech banking partnerships. And when I say banking, also credit union partnerships. Typically to provide a better user experience, user interface that's often appreciated by younger customers or members. In fact, according to the CFPB's research, 85% of consumers that are 18 to 29-year-olds, right? So those are the ones that we want to be targeting if you're a financial institution. 85% of them have tried a digital payment app. So those are the PayPals, Venmos, the Apple Pays of the world. And this number surprised me, but anyone want to take a guess how much has passed through those payment apps in the last year? It's a lot. Lou, you're on mute if you were gonna suggest something. It's 893 billion. So, about 110 billion shy of a trillion. That's a lot of money passing through those. And that number is expected to grow to 1.6 trillion by 2027. So if that doesn't frighten you as a financial institution, I don't know what would. Those, as I mentioned, those fintech banking third-party relationships are complex due to third-party solution providers, due to the due diligence required on those third-party solution providers. I'm going to do my plug here for SRM. For those not already aware, our company offers vendor valuations, due diligence to ensure those new fintech partnerships are not introducing additional risk to the banking ecosystem. But there was certainly a growing consensus, and I think this is reflected by some recent news from the CFPB, that fintechs need to be regulated differently. Right now, they're often regulated at the state level through various state money transfer laws. And furthermore, many of them avoid federal banking regulations by entering into banking partnerships by leveraging their banking or credit union partners, charters, or payment bins. So while we have a robust federal banking regulated regime, there is no federal money transmitter regime. So I kind of hinted at this, but earlier this week, Roha Chopra, director of the CFPB, announced that they intend to regulate larger digital payment app providers, about 17 of them, in the same way that it does banks, subject to CFPB supervisory examinations. So that was met with much fanfare from the financial institutions, that at least those large tech providers would be put on a level playing field, at least as it relates to protecting consumer information and what they do with that data, because there's always been the assumption that they're at an unfair advantage. I'll pause to see if there are any comments, questions before I go on to the next section on payments innovation.
I can't shut up, Larry.
Oh, by all means, hop in.
You guys should be freaking outraged that those peer-to-peer payment providers even exist. I mean, you're talking about going around the block to go next door. You're talking about a well-heeled, well-trained, well-capitalized, and well-staffed league of institutions that already exist to be shepherds of people's money.
I would say, I think I can probably speak for everyone on the phone. If we asked people, they would say yes, they are outraged. But think about how those fintechs have gotten into that position. They've done it by making the onboarding process easy, right? And whoever controls that onboarding process controls that relationship. And they've been out positioning the banks and credit unions as it relates to making this stuff easy. I mean, when I make a payment with my Apple Pay, I double click on that little side button and I make a payment. I don't, I can select whatever payment solution I want. They made it easy. When I wanted a high yield savings account, it took me like a couple clicks and I had my high yield savings account, which, by the way, they required me to get a credit card for and cross-sold a secondary product. But I mean, to some degree, some of these fintech solution providers have been outpacing. But in all fairness to the banks and credit unions, they have not had a level playing field, and I think that is going to change. And so the days of that may be coming to an end, hopefully for the banks and credit unions.
I hope so. I mean,
Yep.
My angle, of course, is about investment products and making sound decisions, but it's just the same for just moving money around. It's ridiculous that everybody else is taking a sip off of something for very little value. Anyway, I'll shut up now.
No, totally agree with that, and I could go off on a tangent about institutions collecting economic rent because they developed a great solution for years that. Well, they continue to innovate, but certainly there are opportunities now to eliminate third parties that are in the middle of a lot of these transactions that probably don't need to be there anymore, or at least you could argue that. But again, that's a topic for another talk. There was, not surprising, a lot of conversations around payments innovation. So, we all know there is a shift happening to real-time payments, real-time final settlement. There's been a proliferation of challenger banks and fintechs that are offering some of these, kind of coupled with shifting consumer preferences. What it means is that companies must adapt to emerging trends or risk losing market share. We're seeing innovations like FedNow, Pay by Bank, account to account, API, blockchain-based payment solutions like stablecoins and tokenization. They're transforming payments and will likely impact card networks and ultimately bank and credit union interchange, and that's a big problem. And it's really being driven by consumer demand. The industry is seeking solutions for payment, instant payments, and B2B requests for payments. Given this growing proliferation of alternative payment solutions, the best approach might be to leverage different networks for different payment needs. So depending on the cost, depending on the speed, the need for finality, consumer protections like chargebacks, it might be one of those things where you could kind of route a payment based on the, kind of those needs, right? You might need speed, but you might not need finality. You might need consumer protection, but you might not need cost or whatever. And financial institutions are increasingly looking to solve this with the concept of payment hubs. And I didn't hear a lot of conversation around that at Money 2020, but I know that's a thing, and we're studying that and looking at the solutions. And these payment hubs are more kind to or akin to like a digital payments ecosystem. So they're typically service focused, cloud based, highly configurable. Not surprising, API centric. They're also fintech friendly, as banks and credit unions increasingly see fintechs as necessary partners in the modernization rather than, say, business adversaries. These new dynamic payment ecosystems could help enable banks and credit unions to provide the user experience and faster payments that consumers have come to expect. While optimizing network usage might be achievable in the domestic market, and this was something one of the speakers said, when it comes to international cross-border transactions, that's going to take some time. There needs to be further alignment, given that we have different payment schemes, different rules, and different international regs. So on the international level, we're probably not there yet. And then, their takeaway was that changes will be driven by market forces or mandate. So it could come either in the US, it's probably going to be driven by market forces. Other countries are a little bit more prescriptive when it comes to banking and payments, and those are mandated. But the consensus certainly is that in the future, instant payments and instant settlements will be the norm. And then the last takeaway I had, actually, let me pause there, see if there was any questions, thoughts, either around payment hubs, of which I'm not an expert on, but I'm going to be one eventually. But payments innovation in general. Anyone want to add something to that?
I know a lot about payment hubs if you need somebody to jump in on anything specific there.
Would you mind giving a little just brief description? It might be even better than the description I gave, and where financial institutions are kind of looking to leverage those, because I think there's opportunity there, whether it's corporate clients trying to make use of the proper payment hubs, or maybe ultimately even consumers that are looking to make use of the proper payment facilities.
So the financial institutions that I've been working with most recently are tier 0, tier 1 size institutions. And those folks have a wide variety of clearings globally a lot of the time, right? Especially big correspondents. And, very few are leveraging a payments hub as a real payments hub where they've got lots and lots of clearings all connected in through one system. That's almost a myth. They've got ancient things built, 20, 30 years ago for wires and various real-time payment clearings around the world. And they're all at these different, stages of the technological life cycle and everything. I think what we're seeing right now is, I think for smaller institutions, they have more options. You don't have to go to any of the Fs, anymore. And I've worked for, one of the Fs. So smaller institutions can get something probably starting. I'd start with FedNow or something that you're just getting into, leave everything else in place and get that up and running. And then if you're purchasing, there are these companies out there like Alacrity, Volante's working with the biggest guys, but they also have something that's scalable at a smaller level. But, really where these solutions are going to be driven from, Lou, is PSCU co-op, right? For the smaller institutions, you're going to have a payment hub, a real payment hub, because you'll be able to build a real payment hub at scale for multiple clients. But yeah, I mean, it's pretty interesting watching what's happening with Visa Direct and things like that. People trying to skip around SWIFT for international cross-border payments. The space is innovating so fast. It's awesome.
And it seems like, I mean, some of the hurdles of the past, because I mean, payment hubs isn't a new term. It's been around a while, and the promise of it probably didn't live up to its promise just because the integration costs were so high and so difficult, right? But now we've got, API and different ways of integrating that make it a lot easier. I think we're finally here with payment hubs. So I think that's, if I had to guess for something that's going to come up big next year, I think it's going to be payment hubs.
Yep. And I know we don't want to harp too much on digital assets, but we had 2 clients that we had built crypto as a method of payment to go through our GPP payment hub. Both Signature and Silvergate were using GPP to route their own internal token settlement. So I was devastated when the government crushed them and FTX blew up, because it really put all of the exciting stuff that we were working on hold, and I'm just hoping it's going to revive now.
Yeah, did the IP for Signature Bank, did that ever get picked up by anyone?
Yeah, it sure did. Who bought those guys? And all the Signature folks are all still there.
Awesome.
What did they do? I can't remember. I'm going to get it wrong if I guess, but yeah, they got picked up.
Good. Yeah, I mean, I know there are other institutions that are looking to do the same thing too. Again, not to harp too much on digital assets, but I think it's gonna, whether it's tokenized assets, tokenized deposits, crypto, stable coins, like this is just gonna be part of our payment ecosystem going forward. And like it or not, we're just gonna have to figure to work with it in central bank digital currencies.
And those 2 examples, the only reason that they were using internal blockchains, which were copies in both cases of Ethereum. The Silvergate stuff also had a bunch of the old Meta DM infrastructure under it, but the only reason was to match the clearing cycle for their securities, or for the businesses that were dealing with the crypto exchanges. So your crypto transaction could settle in near real time, 24/7, 365, but even within the bank, they couldn't settle a transaction that quickly on their legacy infrastructure. So they built a blockchain internally, and we're settling things internally between their clients in real time.
Yeah, and again, I'm going to put a plug in there for Real-Time Liability Network. If anyone hasn't read that white paper, read it. They make a very compelling argument for, again, a shared ledger between financial institutions for that instant settlement to eliminate counterparty risk, settlement risk, because you're doing an atomic settlement. And again, not to go into the details about that, but really a fascinating paper. Last topic I want to cover today, and then we'll see if there's any ones that we might want to add, is there was a talk, and I didn't come up with this term, so don't crucify the messenger, but it was termed death of interchange. So while it's a highly charged topic, there was discussion around the demise of interchange. So not to say the interchange is going to disappear tomorrow, but certainly interchange is going to be impacted either through the passing of the Credit Card Competition Act being pushed by Senator Dick Durbin, and or by competition coming from these new payment alternatives that we're talking about, pay by bank, buy now, pay later, blockchain stablecoin solutions like PayPal's PYUSD. At the end of the day, consumers want choice. I think there's that understanding, and we need to give them their choice, and that at least some of the demographics want instant payment, most notably 61% of millennials. because they want a budget, they want to know these things happen immediately. They're heavy debit users, whatever. Merchants are also really interested in instant final settlement solutions or expanding payment options to capture additional sales opportunities. And there's a lot being done in the e-commerce space. I sit in every couple of weeks on conversations with merchants, and it's amazing their interest in this stuff. And even like leveraging less instant solutions like ACH payment solutions. It was funny that one of the people that was kind of very pro existing, the network schemes, she was saying, well, you've got all these alternatives, but like the stuff that really matters to the consumer are dispute protection, right? For like chargebacks and whatever. And one of the presenters reminded the audience, which I had totally forgot about, but that ACH actually has similar dispute protections for customers per Reg E and NACHA rules. So, that the argument that the Visa and MasterCards are the only solutions out there for payments for consumers, I think is starting to wane a little bit. That was it in terms of what I captured. I'd love to have some conversation. We got about 10 minutes left. Also happy to answer any questions about what I saw, but so far it's been good conversation on this tech talk. I will sit here in silence until someone speaks.
Really, I was going to ask a question. I don't know a lot about Custodia Bank yet, but has anybody done any research or know anything? It seems to be like, I don't know. They kind of describe themselves as a new brand of a bank, right? Or a new brand. They're a depository institution. I don't know exactly how far that goes, but I believe their model is more or less right now. It's a fee generated service model where you can put in your Bitcoin and it's separate from company assets. And so I think it's something along the lines as you still basically hold your own keys to your Bitcoin, but it's a custodian service and they charge a fee for that. But I think they're trying to build some rails into the Federal Reserve or tie into the traditional sort of, system, if you will. But I don't know a lot about it. I just saw some news come across more recently.
So, yeah, there's a couple of us who probably talk about that. That's Caitlin Long's bank. It's chartered out of Wyoming, I believe. It is a special depository institution. They've been fighting to get access to the Fed for a long time. There's a lawsuit out there. The Fed, I think, has been reluctant to do that because their model is very much kind of like the stable bank model, where they're not lending against those assets or rehypothecating, which, from an economic standpoint, in the way banks traditionally work, the two-tiered banking system and a kind of, fractional reserve banking, we need banks to lend that money back out to communities to drive economic activity. And any institution that offers that kind of a stable bank solution where you just kind of deposit, whether your digital assets or real deposits, and they hold it for safekeeping, it just pulls liquidity from the system. And it could be argued that in a risky environment where you happen to have a lot of bank failures, that those sorts of institutions would get a lot of deposit inflows because they wouldn't be lending them back out. That's my conspiracy theory around why Custodial's been having some issues with getting that approval. Caitlin Long seems very, very persistent. So at the end of the day, she may win those lawsuits. Depends, I don't know if that goes up to the Supreme Justices or what, but it'll be interesting to see how that plays out. Anyone want to add some additional color on Custodial Bank?
I mean, I have an opinion, of course. Sorry.
You always do, Rob. That's why I love you.
Yeah. I mean, okay, here's the thing. I think it's a logical fallacy to be talking about, the concept of a custodian against something that's publicly validated and observed. I'm not exactly certain why that's a problem to be solved. it's certainly a problem to be solved, the people that are executing against said blockchains. But there's nothing to custody except the keys. And I went pretty deep a couple years ago, talking about multi-sig and and multi-party, key distribution, and spent a lot of money with my good friends at Perkins Coie in New York, being told, nope, sorry, that's not custody. Now, of course, the lens they were observing it with was, NYDFS and their own chops as understanding the space and regulators. But I mean, there's also not a great precedent out there as well. I mean, didn't Prime Trust go down in flames recently? I know some people who saw them as the gold standard for this new wave of neo custodians. So I just don't really understand what problem they're solving. That's my contrarian mindset.
I like that. I think with Prime Trust, a couple things I could say about that. So
bad actors,
were,
yeah, I get it. Yeah.
Yeah, well, maybe not even bad actors. I mean, first off, they weren't actually a trust, right? So they were at least state regulated, which is good, right? As opposed to some of this not state or federal regulated, because at the end of the day, you can hold people responsible and send them to jail. And that's important. Yep. In the case of them, I think it came down to just kind of bad management of keys. I could be wrong. I might be thinking of someone else. I don't think
there's a great snippet from the testimony that
yep.
points right at that.
And they're not the first ones that's had that problem. So it's one of those things where I think, the tech, it is, when it comes to digital assets, it is new technology, and this idea of managing keys and how to do that properly and how to protect those is not as easy as it might sound.
Non-trivial, that's for sure.
Easy, right? Non-trivial.
But secrets and banking are made for each other.
True, that is, totally agree.
Right?
And there's no reason banks and credit unions shouldn't be able to custody. In fact, there is a credit union that we're going to have on a future Tech Talk called St. Cloud out of, I think, St. Louis, that is going to talk about a custodial solution that they have for credit unions. A number of banks did go early on with custody solutions, I think US Bank included. I don't know that a lot of new ones have, just because the banking regulators have been a little sus on some of that stuff. But again, the Fed did recently start what they call it. It was like a novel activities group to, I think, help shepherd through some of those banks that were struggling, that wanted to launch a unique solution, had got the earlier letters of intent from those 3-letter agencies and said, oh man, we're not going to touch this stuff. But now it looks like the Fed might be a little bit more open to this. So we'll see. Is it a business model that is going to get a lot of traction in the future? I don't know. I think there is a need for custody in a stable, regulated environment. And if we see digital assets take off again in trading and all that good stuff, that holding those things with an unregulated exchange may still at the end of the day not be the best approach.
Just like you would not do business with an unknown counterparty.
Yeah.
Right. See, this is my argument: is I don't think entities need to exist for this solution. I think tooling, infrastructure, and protocol does.
I can't disagree with that approach.
But I'm just always going to run out the clock, Larry, if you hand me the microphone. So
yeah, Jeff, I looked like you wanted to say something. Was there something you wanted to get?
I was just thinking, I mean, just custody alone to me probably isn't as interesting, and I'm just curious if they're thinking more broadly than that, right? I mean, the ability to, today, if I hold my own keys to any asset, digital asset, Bitcoin or whatever, how does that integrate into the payment system? Today, it doesn't really know that well at all. I mean, it does probably to a certain degree, but this company, this Custodia, may be looking to build or be that bridge into that world, and by being a custodian of those assets, connecting with the traditional system, as well as being conduit to the digital space, might be their end game. I don't know.
Well, that's a great point, and that might be another reason why the Fed doesn't want to give them access, because suddenly then there's an on-ramp for US dollars. And that's, at least over the last 2 years, seems like the regulators have been very much focused on eliminating on-ramps to the exchanges. So yeah, that might be it, Jeff. I mean,
Yeah,
that's
they wanted a
part
master account. And if you look at the ripple effect that happened from our good friend SBF, one might easily conclude you don't want something that seismic too close to the core.
True. I will also always make the argument that, at the last top of the cycle with the digital assets, it was a $2 trillion asset class, right? And $1 trillion of it went poof over the course of a couple of weeks, but it did not trigger a financial crisis. It did not cause people to not get mortgages. It did not cause a run on banks. It did not cause the stock market crash. And and part of that's because it wasn't that deeply ingrained with traditional finance, right? So that argument can be made, but the other argument can be made is that the people who were in that space understood the risks and were appropriately hedged or something. But yeah, it's an interesting topic, and it's one that's we're gonna continue to talk about. Well, we're up at the hour. This has been a fascinating conversation. I hope people got something out of this. I obviously enjoy talking about this. I appreciate y'all letting me kind of share my overview from Money 2020. Appreciate, Lou, some of your insights from Money 2020 as well, and all the comments that we had today. So great job, and I look forward to doing something similar in every other week. So thanks.
Thanks,
for
Larry.
pulling us together. Bye.